In 1971, the United States government made a decision that changed the financial lives of every human being on Earth. They didn't announce it like a crisis. There were no sirens, no emergency broadcasts. The president went on television on a Sunday night, interrupted Bonanza, and said, calmly, that things were going to be fine. They were not fine.
What happened that night quietly broke the single most important promise in modern economics. And the strange part? Most people alive today have no idea it ever happened. They just inherited the consequences. Here is the lie, that the money in your wallet is worth something because it is something. It isn't, not anymore. And understanding why that matters right now in 2025 might be the most useful thing you do this year.
Let's go back, way back, not to be academic about it, to understand how a system gets built and why, once it's built, almost no one wants to admit it's broken. For most of human history, money had a physical anchor. You couldn't just print more of it without something real to back it up. Gold, silver, grain, something tangible sat behind the paper. The idea was simple. The government says, this note is worth 1 ounce of silver. You can literally walk into a bank and exchange it. The paper is just a convenient stand-in for the real thing. That system, in its most modern form, was called the gold standard. And under it, governments had a problem. They couldn't spend what they didn't have. If you wanted to fund a war, you needed gold to back the new currency you printed. It was a leash. Some people loved the leash. It kept inflation low, kept currencies stable, kept governments honest. Some people hated the leash, especially governments, especially in wartime. So what did they do? They got creative. After World War II, the world needed order. Economies were shattered. Trade was a mess. Everyone needed a stable currency to rebuild. So in 1944, in a hotel in Bretton Woods, New Hampshire, 44 countries sat down and agreed on something. The US dollar would be the world's reserve currency, and the dollar would be backed by gold, $35 for 1 ounce. Every other currency would be pegged to the dollar, which meant every other currency was, indirectly, backed by gold. It was clean, it was elegant, and for about 25 years, it mostly worked. But here's where it starts to fall apart. The United States was spending massively. The Vietnam War, the Great Society programs, Cold War defense budgets, all of it cost money the government didn't technically have in gold. Other countries started to notice. France noticed. Charles de Gaulle, famously skeptical of American financial dominance, started sending ships across the Atlantic to physically collect gold from U.S. vaults. He didn't trust the paper anymore. He was right not to. By 1971, the U.S. held enough gold to cover about 22% of the dollars in circulation. The math was broken. Everyone knew it. The question was just who would say it first. Nixon said it first. On August 15, 1971, he announced that the U.S. would no longer convert dollars to gold. Just like that. No vote, no referendum, no global agreement. The anchor was cut. Economists called it closing the gold window, a polite way of saying the promise is void. And from that moment on, the US dollar, and by extension, most of the world's currencies, became what's called fiat money. Fiat, from the Latin, let it be done. Not backed by anything physical, backed by trust, by decree, by the collective agreement that it has value because we all agree it does. Which sounds fine in theory, until you look at what happened next. Here's a number, 1971. Here's another number, 2025. In 1971, a house in the United States cost around $25,000. Today, the median is over $400,000. That's not because houses got 16 times better. It's because the money got 16 times worse. A dollar in 1971 had the purchasing power of roughly $8 today, meaning if you buried a $100 bill in your backyard in 1971 and dug it up now, you'd have lost about $700 worth of real value. And here's the part no one says out loud. This is not a bug, it is a feature. When a government can print money without a gold constraint, it has an extraordinary tool. It can fund wars, bail out banks, stimulate recessions, pay down debt, not by earning more, but by making the debt worth less over time. The mechanism is called inflation, and mild inflation, economists will tell you, is healthy. 2% per year. That's the target. That's the goal. 2% per year, compounded over 30 years, cuts the value of your savings nearly in half. The central banks of the world have been tasked with targeting a slow, steady erosion of purchasing power and calling it stability. Again, Not a conspiracy, not a secret. It's in the textbooks. It's in the Fed's mandate documents. They call it price stability. What they mean is controlled, predictable devaluation. The lie isn't that this happens. The lie is that most people don't know it's happening to them. Now, here's where it gets interesting, because the post-1971 system has champions, smart ones. The argument goes, flexibility is worth the cost. When the 2008 financial crisis hit, the Federal Reserve printed trillions of dollars, bought assets, flooded the banking system with liquidity, and prevented a second Great Depression. Maybe, that's the claim. When COVID collapsed global demand overnight in 2020, governments spent at a scale that would have been physically impossible under a gold standard. They mailed people checks within weeks, and the economy bounced back faster than almost any historical precedent. The gold standard crowd, critics say, gave us the Great Depression. Governments couldn't respond because they were handcuffed by metal. Millions suffered. The leash cost lives. Fair point, but here's the other side of that ledger. Between 2020 and 2023, the U.S. money supply increased by roughly 40%. 40% in 3 years. And then, to almost everyone's genuine surprise, inflation came screaming back. 8%, 9%, the highest in 40 years. The Fed's response? Raise interest rates faster than at any point since 1980, which crushed the housing market, hammered small businesses, wiped out tech valuations, and triggered a banking mini-crisis in 2023 that took down Silicon Valley Bank and 2 others in a single week. The flexible system worked, and then it did exactly what critics always said it would. It overreached, and the correction was painful. Here's the thing about fiat currency that never gets said in polite company. It is fundamentally a wealth transfer mechanism. Not always, not intentionally, but structurally. When new money enters the system through government spending, through quantitative easing, through bank lending, it doesn't distribute evenly. It flows first to the people closest to the source: banks, financial institutions, asset owners. Those people buy assets with the new money before prices adjust. Stocks, real estate, companies. The price of everything rises, and the people who hold those assets are richer. The people who hold cash, savings accounts, money market funds, pension checks, are poorer in real terms, quietly, without anyone calling it a tax. Economists have a name for this, the Cantillon effect, named for an 18th century economist who noticed that when money supply expands, whoever gets it first wins, and whoever gets it last loses. In 2020 and 2021, U.S. billionaire wealth increased by over $3 trillion during a pandemic, during lockdowns, while small businesses were boarded up. The system isn't rigged in the cartoon villain sense. It's just designed, structurally, mechanically, to reward asset ownership over labor, over savings, over patience. And the dollar's status as the world's reserve currency means this effect isn't just domestic. It radiates out. Developing nations hold dollars as reserves. When the Fed prints, their currencies weaken relative to the dollar. Their imports get more expensive. Their debt, often denominated in dollars, gets harder to service. The U.S. exports its inflation to the world and calls it monetary policy. So here's where we land. The system isn't going to collapse tomorrow. It probably isn't going to collapse next year. Fiat currency has lasted over 50 years since Nixon's Sunday night interruption of a Western. It has survived oil shocks, tech crashes, housing crises, and a global pandemic. It is, in many ways, remarkably durable. But durable is not the same as fair, and functional is not the same as honest. The lie isn't that money is fake. The lie is simpler and stranger than that. The lie is that the rules you were taught, work hard, save money, be patient, were written for a system that no longer exists. You are playing a game. The game changed in 1971, and nobody sent you a new rule book. The question is, now that you know that, what do you do differently?